Okay, guys, here we go with another episode of What's on Your Mind. We've managed to squeeze one more show in before Christmas. And for those of you that have kind of forgotten what What's on Your Mind's all about, basically, we're trying to give you a bit of insight into what professional traders think about markets and how they manage their own portfolios and things like that. And who better to provide that insight than our I2PM senior trading mentors from over the pond? It's Ben Berggreen and Raj Malhotra. And gents, it's great to have you on the show. Let's get things started. And Raj, perhaps we'll start with you today. How did you want to kick things off?
Yeah, hey guys, good to see you. So today, as we're filming it, it's before the Fed meeting, which is the most anticipated Fed meeting, in a long, long time. But having said that, we have a pretty good idea of Powell's going to talk about the taper and how we're going to move forward with higher rates. Now, I think the market has been obviously a little freaked out about this, but I think I have a bit of a contrarian view to what is the inflation. They've been talking about how it's been transitory the whole time. I personally think that the Q4 reading is the highest it's going to be. It's actually peaked here. Now, I'm not saying inflation is going to go away, but I do think the reading will be lower in Q1 2022. Now, what does that mean for everything? That's what you want to know. Now, the reason I'm going to say that is I do think that businesses have possibly overordered, given that they know their shipments can't get delivered into Q1. So they you order and you hope you get it when your products come. Now I think the contrarian view is what I believe is this could actually mean a supply shock, because if they order everything and actually get all their products, this could cause supply shocks, and this could possibly cause a glut in semis, autos, et cetera, which actually will be deflationary. And having said that, is that a good or a bad thing? It may be a good thing. And the reason I'm going to tell you why is because no matter what level of inflation we're at, the most important thing is that prices are stable. It's better for businesses to manage. It's easier for them to know what pricing, and they can make decisions. Making decisions on prices when they don't know what they're going to be is hard for businesses. It's hard for traders, to be honest. So, even though we'll still have higher inflation readings in Q1 that are higher probably than historical norms, a little bit lower than here and more stable is actually could be good for certain stocks, not all stocks, but certain stocks. So in terms of the consensus, the market consensus, the first hike is going to come in June. I think it's going to be much earlier. I think it's going to be March. We'll see what they say today. And the consensus rate hikes until 2023 is the 3, which I think are kind of about right. But I think they'll be a lot more front loaded than the market's expecting. My guess is they're going to raise them and then just kind of, go and pause again. Now, what all that means is in terms of stocks, it doesn't mean, I don't think 2023 is going to be a gangbusters year for the market like the last two. But, you have to look at pairs trades. What I've been looking at on my own side is I'm looking at reasonable valuation stocks on the long side, and I'll go through one of them later on today. But I've been out of my high flying tech names, and a lot of the names I've actually covered in What's on Your Mind in the past. And I've been looking at opportunities to get back in, because especially with names that actually, even if with high growth names that have earnings, that's a lot different than names that have just sales, and when they're trading at 20 times revenues. Those are not the kind of names I'm looking on the long side. But there are some bargains in the names with growth, as long as they do have earnings. But like I said, a lot of the pandemic winners, they've come down 40 or 50% from the top. And so even though I've out a lot of them, I still have some put spreads on them, but I am a little bit less bearish on them right now. So I'll go through one of my trade ideas later, but I want to get Ben's thoughts on what he thinks on that.
Yeah, hi guys, morning. Like Raj said, there's definitely a lot of uncertainty going into this Fed meet, and I think also maybe Q1. The market's been funky lately, and a lot of these high flyers has come down. And because of that, I am actually looking at a pairs trade this time around. And after this recording, I'm actually heading up to Lake Tahoe to do some serious powder skiing. It's been dumping snow for 3 days, and it's going to continue dumping. So I thought it would be appropriate to talk about kind of a related stock, which is Vail Resorts, tickers MTN. This is a long trade I'm looking at. Vail is obviously in Colorado. I'm not going to Vail, but close enough. They operate ski resorts here in the United States, and it's a $13.6 billion market cap stock. Like a lot of stocks, like a lot of companies in these kind of leisure space, growth got decimated by COVID, clearly. But the thing here, though, is prior to COVID, earnings was just going gangbusters. Like Raj was saying, we want to look at companies with positive earnings now. And this company went from zero, or being in the red back in the day, to being now over $8 per share. So earnings went rapidly higher. Prior to COVID, it got crushed with COVID, and stock obviously got sold off. But after that, stock broke the COVID highs and just continued ramping higher, and it's pretty much been on a tear. As you can see on this chart, I like to look at the stock price, and I like to have the trailing 12-month earnings per share overlaid on the chart, kind of to put things in perspective. And the stock, maybe it's getting a little bit into stretch territory, but I think that's sustainable for the reasons I'm going to discuss. So on the quant side of things, they report earnings in March. And the last 4 quarters, they beat estimates by a pretty nice margin. And earnings growth for the current fiscal year is up 152%. We're going to see, I think we're going to see, margin expansions coming in also. The PEs for fiscal year 1 is 43 times multiple, which is kind of appropriate for a high growth stock. All right. So, and then I also like to look at the estimates going forward, which, looks really solid going out the next couple of years. There's definitely an uptick towards revisions in the future, and there's this solid growth built into this. Okay, so there's a lot of stuff going on here, and there's a lot of elements. But for the sake of this recording, this just short segment, I kind of have to trunk it into a little bit more summarized format. But the biggest thing that's happening with Vail Resorts is the Epic Pass. Okay, so the Epic Pass is a ski pass here in the United States that allows you unrestricted skiing in most of the Rocky Mountain resorts. Now here, where I'm going here in California, we have the Icon Pass, which is kind of a similar thing, but it just covers different areas. So the Epic Pass covers Vail, Beaver Creek, Breckenridge, Keystones, resorts in Utah, and some others. But some of the high-end key resorts. And Vail, they are aggressively trying to capitalize on this shift. There's a shift, I'm not sure if this is going on in Europe, but at least here in the States, there's a shift away from buying a ticket, at the chair versus buying a pass. And it becomes more like a subscription-based type of model. And it also attracts pretty much a higher end customer because you get a more premier, quality service. And Vail actually sold over 2 million Epic passes, okay, for this season alone. They cut the prices to compensate for, the dry up in the business over the last couple of years because of COVID, and they're now aggressively ramping it back up. And the other resort operators are reporting a 76% increase in pass sales. And that's about 900,000 more tickets and passes purchased in advance. Okay, so, and on the last earnings call, the CEO, earnings calls, I don't pay that much attention to it because, they're always going to be optimistic pretty much. But the CEO did state that they significantly outperform their original expectations for the pass sales. So, that's one thing. There's this trend towards this, towards the passes. Right now, they have about a 50-50 split between buying a lift ticket versus buying a pass. And the goal is to get this up to 75%, pass 25% ticket. It used to be the other way around back in 08, okay, but that's kind of the goal. And what that does, so why is that good? It provides a more reliable revenue stream, and it just stabilizes everything. And it also entices people to go more when they have a pass where they have, unlimited access. So you just get more, more fun. I mean, I'm going today, probably going in a couple of weeks, because the weather has been is really dumped over here, not only in California but also along the Rockies. And weather, as obviously as a ski resort, weather is a big deal. It has a huge impact. But we're now looking at a much colder winter than normal. I mean, I'm here in Malibu, California, and it's been freezing cold. I'm sitting here with a big fat sweater. It's been unseasonably cold. But that's good for these resorts. Okay, so I mean, I have a chart of the predicted snowfall here over the next 10 days, and they're getting 10 feet of snow. And another thing is ticket sales are limited because there's been such high demand, and they actually kind of restricted the amount of tickets you can buy because of COVID restrictions. And the Icon passes that I have are sold out, and also it's hard to get hotel reservations. So obviously the risk in this case is if there's a sharp rise in COVID and they start restricting everything a lot more. But this is why I'm gonna do this as a pair trade. I'm gonna get into that in a little bit. For those of you who know me, I also like to look at the charts and the technical things. And this stock broke out of this kind of range area back in November, December last year. I just kind of powered up through, got up above 330, which is now working as a support level. And the recent highs was 375. And I think going on this trajectory, obviously it's going to might be a little bumpy ride, but we could probably get to 390 in Q1 at some point. And by the way, I like to buy strong companies with, kind of uptrending price, where the price is also kind of what's perceived as a temporary pullback. And these are pretty high likelihood setups. So let's presume, I'm going to talk about, obviously you can just buy the stock, clearly, but let's look at a trade structure using options. So presuming a $3,000 trade, I'm going to look at a vertical spread going out mid-April. Okay, and you can see the options chain here, and this is what it was yesterday when I wrote this up. So anyway, the 330 April calls, you can buy them at $26 a contract, and I compare that with shorting in April 390 calls at 12, which is above the resistance level, and the goal here is for the stock to get to 390, but not really that much higher. And net spend will then be 26 minus a 12 premium, which is 14 times the 100 multipliers, $1,400 times 2 contracts, which is a $2,800 max spend. Okay, and that's also the max loss if the stock stays below 330 at expiration. If the stock is at 390 or above at expiration, you're looking at a max gain of over $9,000. And the math in that is the difference in the strikes, 390 minus 330, which is 60, minus the net spend of 14, okay, which is 46. 4,600 times the 2 contracts, it's $9,200. So this is a pretty high probability trade. It's a 3-for-1 reward risk. And this, this trade can stand on its own. It doesn't have to be paired, but because of everything that's going on with COVID and whatnot, I'm looking to pair it up with something else in the same kind of space. Okay, and the one that I'm looking at, which I think is appropriate, is Carnival Corp. So Carnival Corp, they're in the same travel leisure industry, but they operate cruise ships, cruise lines. All right, so it's a $20 billion market cap company. They also actually had an airline back in the day, in the 90s, which I actually used to work for. I used to fly their 727s in the late 90s. as my previous career as an airline pilot, and they went under. It wasn't my fault. Like I didn't crash, right? But even back then, it was a shit company. Okay, so they had been struggling for a long time, and like like Vail and a lot of other companies in this segment, earnings took a big hit from COVID. The difference here is that it never recuperated. They're still losing a ton of money. The stock, barely bounced. And if you look at the quants side of things, they've been surprising to the downside for the past 4 quarters, each quarter. They report in January, so we'll see how that goes. But earnings are still in the red. And since we have negative earnings, I like to look at revenue as the better valuation metric. And the price to sales of this company is 30 times because of revenue just being destroyed, right? So that's kind of it's more than most high growth tech stocks. So it's just ridiculous. Estimates going forwards are just, getting worse and worse, going further out in time. So this is a bad situation getting, turning into a worse situation. And I have, there's more going on here, but, if COVID and Omicron and all this stuff doesn't like calm down soon, pretty much the last place you want to be is stuck on a cruise ship with thousands of strangers from all over the world. It's like a cesspool for this disease and rot. Like, who the hell would want to do that? And this is what's been happening, right? So past couple of years, most of their cruise ships have been docked for, better part of 2 years. And it costs a lot of money. I mean, there's huge maintenance costs going on, storage costs, and a bunch of other stuff. So during that time, the company had to finance itself by issuing debt or equity financing. So they almost doubled their shares outstanding and actually tripled their debt over the last 2 years. And they're burning about $2 billion a quarter. It's retarded. So as of the last quarterly filing, they're carrying $32 billion in total debt, which is 3 times what it was a few years ago. It has stabilized somewhat, okay, but it's still way out of control, and it's just not sustainable. And there is, the other catalyst. It's it's COVID related, obviously, but not only that, but there's more and more travel restrictions that is, well, we've seen it kind of come and go, right? But this is why I'm looking at this as repairs trades, because who knows how this is all going to pan out. But they get a lot of customers from Europe, and the travel restrictions between the US and Europe has been kind of an on and off type of deal. Right now, it's not looking too pretty. I have a lot of family in Europe, and it's really hard for us to travel. And it's pretty safe to assume that this is just going to take a long time, really, to open up. Not only from a regulatory standpoint, but also from a mental standpoint, from people to actually want to go on a cruise when all this stuff is going on. So, and this company, was losing money before COVID was even a thing, right? So it's just not a pretty picture. So I think it's time to jump ship on this one. Pun intended. As far as the technicals, the stock has been in a major downtrend. Actually, before COVID, the stock price was suffering. Okay, and it broke lower. It just kind of had a small bounce at the lows, and it didn't even get close to the pre-COVID highs. And it's now made, you can see that on this chart, we call this a bear flag, okay, where you get this kind of dead cat bounce. It's pretty classic for a stock that is under pressure. Support is around $10 to $12, which are the lows set in 2020, but it could easily break lower than that, and I wouldn't be surprised to see it down to like $10 pretty soon. Okay, so all that said, how would I then structure this to pair it up with MTN? Now, I'm looking at the same $3,000 trade, and I'm going to also look at a vertical structure here. So looking at a vertical put spread expiring in April, you can see the chain here. Looking at the 17.5 puts, can buy those at 190, and short the April 12.5 puts at 60 cents. So the net spend then is 190 minus 60 cents, which is 130, $130. 23 contracts makes it $2,990 outlay, which is also the max risk if the stock gets to above 17.5 at the expiration. But if the stock is at or below 12.5, you're looking at 17.5, which is a long put strike, minus the 12.5, which is a short put strike, which is 5 minus 1.3, which is the premium that we spent. Okay, so that's 3.7 times the multiplier times the 23 contracts. Follow my math here, is $8,510 max gain. So again, this is another 3 for 1. And each of these can stand on their own quite well, but they can also be structured as a pair. So just to summarize this combo, so MTN max risk 2,800, MTN max gain is 9,200, CCL max risk is 2,990, and CCL max gain is 8,510. So if they both hit their max loss, which is highly unlikely, the absolute max loss is $5,790. And if they both reach their max gain, which is more likely, is $7,710 gain. Okay. And if there's kind of the most likely scenario here is obviously a combo, right? So let's say MTN is at its max loss and CCL is at its max gain. So that'll be 8,510 minus 2,800, which is $5,710. And if the other way around, where MTN is at its max gain and CCL is at its max loss, you're looking at $6,200 gain. And I kind of blew through all these numbers, okay, but it's not that complicated. I go through a lot of this stuff in mentoring, and typically what happens is it's more of a combination of these scenarios. That's kind of the most likely outcome. So anyway, that's what I'm looking at. These two trades can operate on their own, but they also look pretty nice as a pair.
Yeah, I think that's a smart sort of pair to look at. There's lots of reasons, like you said, that even though they're in the same kind of sector, there's plenty of reasons why Vail will outperform Carnival Cruise, given COVID and everything. Raj, let's go over to you. You mentioned at the beginning of the episode that you had a stock you were looking at that kind of tied in with your macro as well.
Yeah, sure. I have a great stock idea. Before I go into that, I want to say I do like Ben's bearish trade of actually going to a mountain rather than going to a ship. So even if you don't like the stock trade, I certainly like that as a vacation trade. But yeah, but to your question, in terms of the stock that I do like, or a name that I've been looking at, is Cleveland Cliffs, CLF. It's a mining and natural resources company. The company specializes in mining, pelletizing iron ore, steel making, stamping, tooling. Their main, their best businesses. They're the largest flat rolled steel producer in North America. So that puts them well positioned in the auto market, much more than its peers. And another thing about this company is they have some ESG headwinds as opposed to their other competitors. So that should satisfy the woke crowd that wants to invest in the market. In terms of the company, it's been very, very profitable this year and next year as well. The problem, the reason the stock's a little bit out of favor is because there's long-term concerns of 2023 and onwards. But I think some of those concerns are way overdone. So let's look at the most recent quarter. Right now, the company is a little over a $10 billion market cap, and the PE is at a 5 PE, which is about as low as you're going to get. Especially if you look at the earnings per share. The earnings per share in this quarter was $2.33 a share. So if you extrapolate that, it's somewhere between $8 and $9 over 2021. And their revenue in this quarter was $6 billion. Their consensus was $2.23 and $5.7 billion. So they beat both of those. The most impressive number was their revenue growth year over year. It grew 265% year over year. I mean, granted, there was COVID there, but still a phenomenal increase. And if you look at the 2022, and if you look at the analyst community, one of the reasons I do like this, especially as an option trade, is there's a huge discrepancy on the expected EPS. Some analysts are expecting $3 a share, all the way up to like $7.50 a share. So, that's about as wide as a non-consensus, in this case, estimates for a company. So, any upside surprise towards the higher end should really have really propel the stock much higher. So, now that we're at the end of the year, the reasons I do like it, especially in 2022, it's obvious, like I said, it's very cheap. It's an extremely low PE, and they have very little debt. Another thing is the automotive production in Mexico is starting to recover, and that's a key market for them. So as I said earlier, as cars actually come back to the market, I do think that they're well positioned to succeed. Now, another reason the market doesn't like is high steel prices. The market expects them to come down, and while I think they will be here a little longer than many expect, I do expect them to come in a little bit. However, I don't think that's a negative so much as the market's saying, because I believe that even if steel prices soften, I believe the steel producers will be able to make up for that loss with increasing sales volume. So, like, if you look at the new car prices, a lot of people at the lower end of the consumer chain were just not able to afford new cars. But I believe if they do soften, companies will be able to make up for it with new sales, because I really do believe at the lower end, wages are going to continue to stay strong going forward. I really believe that we haven't had a wage increase at the lower end of the consumer chain in many, many years. And I do believe that will, given the labor situation, that will continue. We will have that wage, those wages will stay high, and which means more disposable income to buy big ticket items like new cars. And especially if new cars don't actually go much higher, even if they decrease a little bit, or at least they stabilize, those people will actually be able to buy new cars. So they'll make up for it in volume, even if they're lower, even have to sell their steel at a slightly lower price. They'll make up for it in quantity. So when you think about it, like I said earlier, price stabilization, even if steel stabilizes at a slightly lower price, it's good for manufacturers and it's good for consumers. And I think the market's underpricing that. So I think that's something's really being missed. In terms of like some of the stuff Cleveland Cliffs has actually prepared themselves for 2023 and onwards, they've really done some interesting M&A deals, which is really going to bring them more shareholder value in the long run. I think even though it's classified as defensive stock, I think there's a lot of things they've done to go on offense going forward. If you look at where it's trading, the company's trading in a company that feels like they will have no new business for the next 5 years, and I totally disagree with that. A couple of catalysts I've noticed in terms of the M&A deals. So they actually acquired last year AK Steel and Metal USA. Now these deals are not just growth opportunities to me, but I think they were necessary to solidify the company's competitive advantages through vertical integration. And they really did not pay a very high multiple. They paid less than 6 times EBITDA for these two companies each. So I think the market will start to soon see these advantages when the company starts announcing earnings, because I think it will actually reduce their seasonal volatility of earnings, which is something that investors like, and improve profitability and the cash flow profile. Also, during this recent Omnicron dip, whatever you want to call it these days, they did see large insider buying from the CFO, CEO, and other board members. Now, I like to point that out because I get this question a lot about, is insider buying or insider selling important? Insider selling to me is not that important, because insider selling, a lot of times people are just selling stock just to raise cash to buy a house or whatever they want to do with it. But if you see insider buying, of all the things they could do with their cash, they're actually going to the open market and buying stock. A lot of times that means that, in this case, I think they think their stock's undervalued. So I think that's not the reason I'd buy a stock, but certainly a positive data point. Another thing that the company's doing is they're actually going to redeem their convertible notes, which were supposed to be due in 2025 in January. So if you look at how that works for the corporate structure of a company, this retirement of the debt will reduce its share count, and when they reduce their share count, that will increase their EPS, and that stock will look even more cheap. And especially, like I said, if 2022, if you're looking at value, there's not much more value than this. The stock that's already traded at 5 PE and probably will trade lower simply on as they reduce the share count. And they've also said with this retirement and whatever else some other things they're trying to do, they're trying to go to zero debt, and that should happen very soon. So zero debt. So what should happen with that? If rates rise, CLF would be fine because they'll have no debt, and they'll be in a position to basically, if other companies are in trouble, they'll be able to acquire them or take over, consolidate them, be able to buy any other company or really position themselves better while other companies are struggling to finance debt. And to me, like the demand in the steel market, given the infrastructure bill going forward, it's just too high. And this bull market in steel is not going to end anytime soon. Maybe it's not going to be up at these levels, but steel demand is not going anywhere anytime soon. And so the bottom line on this is the strategic capital allocation has created solid competitive advantages, and they're almost impossible to replicate, and that should propel the stock higher in early 2022. All right, so in terms of structure on the trade, I was looking at buying the April 20 calls 2 times and selling one of the January 23 calls 1 time. So a 2-to-1 ratio. I think you can buy the Aprils for around $2.35 and sell the Januaries for around 35 cents. So if you had about $9,000 to spend at home, you could buy 40 of the April calls and sell 20 of the January calls. So on a 1-to-1 basis, if you stock gets to 30, which is kind of the midpoint of a lot of analyst estimates, it's almost a 4-to-1 ratio, a 4-to-1 risk reward on a 1-up basis. And it's obviously much more since you're actually buying more of the Aprils, it's much more than a 4-to-1 risk reward. So it really does set up pretty well, in my mind, for a name that is at a very low PE, has value, and value is actually in vogue right now. So it's important to have some value trades in your portfolio, and I think this is one that really sets up for me.
Nice. Well, gents, I think with that we'll get to the end of the show here. Thank you both for kind of sharing your thoughts and ideas once again on the episode. There's certainly plenty of insight to kind of take away from that and think about over the holiday period as well. Now, for you guys and girls watching from home or wherever you are, we've got one more event for you guys to take advantage of before Christmas, which you might just be able to sign up for if you're very quick once this episode airs, but no guarantees. I don't make the rules here. But that is our end of year conference on Saturday, the 18th of December. And it's basically an all-day conference. You guys will have heard me talk about this before, but an all-day conference with a lot of our senior trading mentors from ITPM, as well as our managing partner, Anton Creel, as well. They're going to be talking about various trading topics, which should really kind of get you in the right kind of spirit and mindset for managing your own portfolio and money going into the new year as well. So if you can, definitely sign up for that. It's you won't be disappointed, that's for sure. But aside from that, I think all of our other events, our next events, as well as our next What's on Your Mind, will all be in the new year. And so with that in mind, until then, it's happy holidays, and we'll catch you all then.